Live from Singapore, this is Insight with me, Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian equities climb as traders prepare for the U.S. election, markets weighing the prospect of a Donald Trump presidency, with most major polls showing a tight race with Vice President Harris. Singapore's $300 billion investment firm Temasek is betting big on the U.S., preparing to invest more than $30 billion there over 5 years. We'll ask the CIO if the election result will have an impact on that plan. We also speak exclusively to the CEO of Keppel, the massive conglomerate that has global interests, including property, logistics, telecoms, and asset management. We discuss whether geopolitical tensions are complicating the business environment. And another big exclusive, GE Aerospace CEO Larry Culp tells us about supply chain issues that are slowing aircraft engine deliveries and what he's doing to address the issue. Well, markets have been busy in the past month, baking in various U.S. election scenarios. Avril Hong is here with the results of our latest MLive polls. And Avril, respondents think the stock market would perform better under Trump, and we're seeing that already.
Indeed. I mean, if you base on the poll, those 350 respondents to the MLive poll survey, based on that sample size, if you take a look at the response, 38% see the S&P 500 accelerating 1 year from now under a Trump administration versus 13% under a Harris administration. Note here, though, that home buyers are seen as benefiting under Harris because of what this might mean for mortgage rates, and Bitcoin investors might do better under Trump. Note here as well that for the S&P 500, it has, after all, accelerated more than 20% already this year alone. Let's flip the board and take a closer look at this next chart, because it gives you a sense of, for stock market investors and performance, what might matter more ultimately is economic fundamentals, earnings outlook, not so much who is in the White House. And if you look at this chart, it shows you the performance of the S&P 500 6 months after an election and before. And this data goes back to the 1990s. It shows you that on average, the S&P 500 rises 6.6% after versus pre-election. So you get the sense that either way, U.S. stocks will rally us.
So maybe it doesn't matter who's in the White House. Avril Hong, thank you. Let's dig deeper into the opportunities and risks around the U.S. election and bring in Rohit Sipahimalani, CIO of Singapore state-owned investor Temasek. The net portfolio valued reached close to $300 billion as of March this year. Temasek in July flagged plans to invest $30 billion in the U.S. over the next 5 years. Rohit, good to have you with us. Welcome to our space. The first time you're doing a live interview with us. We know that 22% of your portfolio actually is in the U.S., so that's a huge amount. And people are saying that this is a market that's already anticipating a Trump win. I mean, how are you looking at it?
So 22% by any standards is actually underrepresentative in terms of where we should be in the U.S. And I think which is why, and that's partly because we opened offices there only in 2014. And prior to that, we're primarily an Asian investor. So clearly the U.S. is a market where we want to deploy more capital. And while I guess who becomes president is definitely going to matter, for us, we try and invest alongside secular trends that should do well regardless of the presidency or the environment we are in. So I think, we will continue investing in the U.S., but I do think depending on who becomes president will make a difference.
So how will it make a difference? If it's a Trump win, how would you deploy your resources?
Actually, it depends a lot. The impact firstly will be more on markets outside the U.S. than in the U.S. Because if you have a Trump win, it is probably going to mean a stronger dollar, higher rates than you would otherwise have in a Harris administration. The tariffs are going to create uncertainty, which is never good for investment. And actually, I think it'll be negative not just for emerging markets, but across the world, across the U.S., and will impact global growth. Now, ultimately, the U.S. is not going to be immune to that. because 25% of the S&P 500's revenues come from outside the US. So actually, I know the conventional wisdom is and consensus is that right now a Trump presidency is better for markets, and I think the immediate reaction probably will suggest that because of lower taxes, deregulation. But as you look out to 2025, picture is not that clear. Now, for us, what it means is that, outside the US, focus more on companies that are more focused on their domestic markets, less influenced by, global trade policies. In the US itself, there's still some secular trends, and things like AI are not going to sort of change under any presidency. And so, things like data centers, for example, is an area where there will continue to be a lot of investment. We continue to see opportunities there. And like that, there will be secular opportunities elsewhere. And there are things like the IRA which could be impacted, but then, we don't make an investment on the assumption of IRA benefits. That may give a boost to returns, but that can't be the basis for our investment. So, steady as we go, I think we'll continue investing in the US.
But how does that differ then if Harris were to come to power? I mean, some say that perhaps if she's in power, we'll see lower rates.
So that will be more beneficial for emerging markets. So in a Harris presidency, we will be more constructive on emerging markets, particularly because, as you said, lower rates, weaker dollar, and less trade tensions that would destabilize confidence. And actually, emerging markets is interesting because they've done nothing much in the last decade. But that's partly been because whether you take the last 5 years or 10 years, earnings growth in emerging markets as a whole has been close to zero. That has inflected this year. We are projecting mid-teens returns in EM this year, and you're projecting double-digit growth in earnings in the next 2 years. Now, with that trajectory, actually, it could again be a good environment for emerging markets, which would suggest allocating more there. But if you have a Trump presidency, that creates new issues which we'll have to navigate through.
The thing is, right now, there seems to be a lot of complacency in the market. What's the market underpricing at this stage?
A lot of tail risks. I mean, today we have wars, we have economic fragmentation, we have political polarization, we have social unrest, and in all that, the S&P is trading at 22 times forward earnings, and assuming on the basis of a 14% earnings growth in 2024. And this is on the basis of margin expansion of what are the peak margins ever in US history this year. So you're already priced to perfection. I mean, the last time the US traded at 22 times earnings was when real interest rates were -1%. Today they're close to +2%. So you already got to believe, and maybe the belief is that AI is going to be this huge productivity boom, which will continue to let margins expand, and everything's just going to be perfect. So in that sense, I think there is a risk to the markets, and I'm sure there will be 2025 will probably be more choppy than we've seen in the last couple of years.
The thing is, it's quite confusing, the indications, the signals we're getting from the market. We talk about how the S&P continues to grind higher. We're talking about 22, 23% on the year. We have treasuries getting sold off. We have gold close to record highs. What are the indications? How do you read the market today?
So given the spike in 10-year yields we've seen over the last month, you would have normally thought equities would correct. That's normally what you would expect. But this spike in yields has been on the back of better growth data, and now the view that the US may be headed into no landing, let alone a soft landing. The Fed has also indicated they're going to be ahead of the curve. So the belief is that even with this stronger outlook, the Fed is going to continue cutting rates. And that will provide a further stimulus to growth next year as the private sector capital expenditure steps up. So that's the environment where I guess people are looking at, and people are looking at a favorable outlook for equities. Now, the gold thing is actually is a little unusual because with higher real rates, you would assume gold would not do as well. But clearly, therefore, there is a concern about debasing of fiat currencies. And that's something, again, we've got to be conscious about. So real assets, whether it's around commodities or infrastructure assets, I think they'll have to play a more important role in people's portfolios to hedge against that risk.
Where to for 10-year yields? Currently 425, some say 450 by the end of November. What are your own assumptions, and what do you make of people saying it could get to 5?
So at least short-term rates, we do see continuing to decline from where they are right now. Because as I said, the Fed wants to be ahead of the curve. They're comfortable with the direction of inflation. And they do see the short-term Fed funds rate being restrictive and well above their view of neutral. So how far it'll go, I'm not sure, but I do think you will sort of see that coming down. In that context, I don't see, the 10-year going to 5%, unlikely in the near term. Depending on who wins the elections, you could see a spike up to 4.4, 4.5%. It's very possible. But in a Harris win, you probably see yields come down.
We spoke to Ed Yadani just last week saying that, the bond vigilantes have been awakened. How much pressure do you think those bond vigilantes would put on the market?
They could, and we saw that, in last year, in the third quarter, around October, actually around this time last year, just when rates almost spiked to 5% and then pulled off. But keep in mind, right now, we've got about $7 trillion in money market accounts in the US. A lot of that is in short-term paper earning 5%. If you see a decline in short-term rates and you see long-term yields go up, I would expect at least some of that will start moving into longer-term bonds. And I do think that will there's so much liquidity out there, I do think that will put some cap or lid in terms of long-term yields. In
terms of where you should be putting your capital, some say that perhaps you'll see further upside in the Magnificent Seven. We've seen spectacular earnings. We'll continue to do so. Some also talk about a broadening of the space. How do you best play that AI sector?
So firstly, in terms of broadening of the market and just the Mag 7, yes, they've done brilliantly this year, but since the beginning of the third quarter, actually the Mag 7 has underperformed. Just Q3 in itself, the S&P was up 5.6%, the S&P equal weight was up 10%, and the Mag 7 was flat. And that's partly because this is a year in 2024 when earnings growth for the Mag 7 is around 33%, and they're trading at about 30 times earnings. The rest of the S&P is showing 5% earnings growth this year and trading at 19 times earnings. So clearly, there's a reason to say, let's go to the Mag 7, because their higher earnings growth justifies the higher multiples. But as we go into next year, consensus is for Mag 7 earnings growth to be 18-19% next year and 2026, whereas the rest of the market is expected to grow at 12 to 13%. So in that narrowing of relative growth, you are seeing a broadening of the market, and that's what we saw in the last quarter. Having said that, as you said, if you're looking at AI as a theme, the Mag 7 or many of them actually are going to be are either huge enablers or adopters. And in that sense, there is a secular trend behind them. So I don't know whether they will, depending on the environment, they may outperform or underperform the rest of the market over the next 12 months. But on a resilience perspective, I do think they will, in absolute terms, they should continue to do well.
So how are you deploying your resources? Because I know back in June, if I'm not wrong, you invested billions in the tech space in the US. Are you looking at building on that position?
So we continue to invest in the US. We're looking at things very bottom up. And so there are, yes, it's a stock-by-stock call.
Such as?
Well, I can't mention individual companies we're investing in right now. But what I will say is that we are looking at that broadening of the breadth in terms of performance. So it's not just looking at the Mag 7, but even on the AI theme, whether it's around data centers or the value chain out there, whether it's sort of energy around that powering the data centers, or whether it's cooling technologies or other things like that. So we are broadening the range of things that we are looking at to play the AI theme, for example.
And you're hedging how?
Well, we're a long-term investor. In any case, about 80% of our portfolio is illiquid. So, hedging a portfolio of that size isn't really practical. What we look at really is portfolio construction and to have balance. So, particularly in an environment where there are a lot of uncertainties, and as you said, many of them are not being priced in, it's important for us to have investment in companies which have strong cash flows, stable cash flows, and they're likely to do well across different environments. For example, we talked about trade tensions, geoeconomic fragmentation, so focus more on companies who have access to large domestic markets. On the other hand, inflation is a bigger risk in the next few years compared to the past, and so therefore look at assets that would be beneficiaries of that, and that includes commodities, some infrastructure, et cetera. So we're trying to have that balance in our portfolio to make sure we can navigate over a 3 to 5 year period, we get fairly stable and good returns. and we just navigate the short-term volatility.
And by stable and good returns, it's about 10%, 5%. What's that stable
So for an
return?
equity investor, we would want to target at least 10% returns.
All right, hang tight, Rohit. We'll have more with Rohit Sipahimalani, CIO of Temasek. Still ahead this hour, we'll hear exclusively from GE Aerospace CEO Larry Culp about why he's still confident in the aviation sector despite supply chain challenges. Plus, later on in Bloomberg, we'll have an exclusive interview with Goldman Sachs Chairman and CEO David Solomon. He'll be speaking to us live from the Future Investment Initiative in Riyadh. Plenty more ahead. Keep it here with us. This is Bloomberg. Now to China and its unveiling of the boldest economic stimulus since the pandemic. Beijing says it's aimed at lifting domestic demand and hitting this year's growth target, and we're talking about 5%. Temasek CIO Rohit Sipahimalani is still with us. He says how the stimulus is actually applied is the key factor. So it's not the amount, Rohit, not that 10 trillion yuan that people are talking about, but how it's deployed.
Look, ultimately, the size will matter, but I think what's more important near term, as you said, is how it's applied, because that will determine its effectiveness, and that's what's important from a structural perspective. And so, for example, they've been talking for a while about making bonds available to local governments to buy back property to stabilize prices. But in the past, provincial governments haven't used that because, A, the economics don't work, and secondly, they're overburdened by debt that they have already. So you need to address some of these structural issues. So that's why I say that how the stimulus is applied is going to be more important. You know, if it's working, if it's not enough, they can always do more. But you've got to make sure that it starts working.
Do you think the how will be addressed perhaps at the upcoming MPC meeting?
I would hope so. Clearly, there's a recognition that they need to address some of these issues because they've seen things that haven't worked in the past. So I would expect some of that to be addressed. And to me, that would be more important.
When it comes to your own portfolio, you're 90% of your portfolio in China, and you're pretty invested in healthcare, in property, in a lot of the sectors in China. How is it looking on the ground? I mean, how realistic is it for people to expect a turnaround in sentiment?
So that turnaround in sentiment is very critical because that consumer confidence is what is going to be important, not just for the real economy, but also for the capital markets, because that's what's going to drive consumption, get you away from deflation. But at the same time, also in the capital markets, the consumer confidence is needed because you can't rely on Western capital flows right now. But there is a lot of domestic savings, which earlier used to go into property or trust products, and now is going and earning 2% in the bank instead of going into the equity market because people don't have confidence. Goldman recently had a report which said that if you look at the pre-COVID trends, about of the 150 trillion yuan in deposits, about 45 trillion is what they call excess deposits. And so if that confidence can return, then if part of that can go to the market, that's going to be pretty critical. So we really need to see steps, and an important part of that confidence is arresting the slide in property prices. That's the number one thing that needs to be done. And then, of course, you've got to make sure that, ultimately the confidence that it creates amongst entrepreneurs also creates more jobs and so on and so forth.
If you don't see that confidence returning, might you pull out a bit of investment from China and put it into the U.S.?
So in any case, are looking to increase our exposure to the U.S. because, as I said, we are underrepresented by most global benchmarks. But would that be at the expense of China? Or perhaps in countries like India? So it'll depend a lot in terms of the opportunities, because we look at things bottom up. Already in China, in the context of everything that's happening, the areas where we're focused on are ones that are, A, reliant on the domestic market, so not subject to U.S.-China tensions, and also which are not subject to risk of government regulation. So, for example, the entire consumer sector, it's a big opportunity, but that's one opportunity. Similarly, there would be, other areas like on the sustainability side, whether it's EVs, et cetera. Yes, they may be subject to trade barriers in the US and Europe, but China is such a big market. If the opportunity can be justified at valuations that are just reliant on the China market or the global south, yes, we will look at those. So we have identified areas within China that we like, that we think have a long runway, and we'll have to selectively look at those opportunities. It's clearly a narrower opportunity space compared to the past.
So it would be in areas like renewables.
Could be renewable.
EV.
Could well be, but also general consumer, food and beverages, cosmetics, consumer durables. These are things which ultimately China will need. It's a huge market. And domestic brands are gaining share over international brands as A, they become better in quality, but also as they offer better value for money.
But the thing is, consumption is what's being depressed right now, and China is finding it difficult to turn around that sentiment even amongst its people.
So that, as I said, is the key thing. And if you ask me, whatever policies the government does right now, they will need to iterate a few times before they get it right. Because there are behavioral issues to address in terms of bureaucrats' willingness to take risks, for example. There are the structural issues that need to be addressed. So it's not going to happen overnight. And therefore, I do think the next 1 year will be bumpy, and it's going to be more of a trading market. But after that, during this period, we should have clarity as to the direction of where we are going. You know, are we back to getting away from deflation? And you'll never get back to the old growth rates of China. But in terms of steady growth, 4.5%, 5%, but with inflation of 1 or 2%, or we are stuck in this deflationary rut that we are in right now.
What's key, of course, is the property sector. We've seen the worst, perhaps, and that's enough to perhaps be a bit more optimistic about a turnaround in the Chinese economy?
As I said, the key thing out there will be how the stimulus is applied and the mechanism for doing that. Because you need to arrest this decline in property prices. It can't come only from the demand side. It also has to come from the supply side. And you need government support for that. But as you said, it is critical and something that we are watching closely.
China versus India. We've seen an outflow of money from India going into China. Is that sustainable? Some people say unlikely to be sustained.
So India was the darling of the global markets for the first 9 months because they had the long-term structural story. Secondly, people expected accelerated earnings. And you were having inflows both from FIIs and domestic investors. Now, some of that has changed since the beginning of October. As you said, there's been about $10 billion of FII outflows. Part of it may be because of the appeal of China, and people are so underweight China, they need to rebalance that. But part of it is also because earnings this quarter have disappointed. People are seeing a slowdown, particularly in consumption. The central bank is actually encouraging banks to less lend on an unsecured loans basis to consumers. There's less lending to NBFCs, which impacts SMEs. And so you are seeing a cyclical slowdown in growth right now. So to that extent, you've had these outflows. Ultimately, I think the China story is not going to be dependent on outflows from India. It's going to be on flows from the rest of the world because people are still very underweight China. And so if China can get it right, there is enough capital to flow in. But as I say always, I mean, the ultimate upside in China is not going to be from Western capital. It's going to be domestic capital. There's so much of it. You just need to get sentiment back to get that into the market.
In just 15 seconds, what is a must-have in India? What must you own in India?
Well, we are very exposed to banks. We're very generally the financial sector in general. We're very exposed to healthcare services. Both of them, we think, have structural tailwinds and will have a long runway for years to come. There are many other areas too, but I'll just identify those 2 key areas where we are invested heavily in.
Rohit, a pleasure to have you with us today. Rohit Sipahimalani, CIO of Temasek. Let's take a look at how Asian benchmarks are looking. Of course, it is a big week for markets on the back of data, U.S. jobs out of the U.S. this week. And don't forget the upcoming election. And of course, we have the earnings of the Max 7. Up next, Singapore asset manager Keppel will be joining us for an exclusive interview. We'll get insight on the firm's outlook for China's property market with CEO Loh Chin Hua. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. We're tracking mainland Chinese markets as they head to lunch, taking a look where we are in terms of CSI 300 index under pressure, down 0.6%. Of course, markets looking for more clarity, more direction from the upcoming MPC meeting. The Hang Seng, though, in positive territory, in the opposite direction, up by 0.5%. Well, U.S. investors also growing more skeptical over China's market outlook and stimulus plans, pulling a net $160 million from ETFs investing in China just last week. That's after a recent run of massive inflows, as this chart shows. Our next guest runs Singapore-based Keppel, which specializes in infrastructure, asset management and property businesses. In real estate, its portfolio comprises investment-grade commercial properties, residential developments, and integrated townships. Keppel is diversified in Asia, with China, Singapore, and Vietnam its key markets, while it continues to scale up in India. Joining us exclusively, CEO Loh Chin Hua. Chin Hua, good to have you with us. First off, when you take a look at the micro, or rather macro environment, pretty challenging. How are you assessing it?
Yeah, well, the world is becoming a more difficult place to operate in. There's a lot of macro risks out there. But the areas that we are very focused on, primarily infrastructure, providing essential services, we believe that the trends are still very positive. So despite the very choppy markets ahead, I believe that we're in the right space at the right time.
Speaking of being at the right space at the right time, let's talk about China. Your big investments there.
Sure.
Property, a very, I guess, is the focus for the economic recovery for China. How are you assessing it? Have you seen the worst?
Yeah. Well, I think for a start, Keppel has been in China now for just over 30 years. I think we have obviously for the first 30 years very focused on the real estate market. Back in 2017, we started to de-risk from the Chinese market. We have sold some of our land banks there. We have also repatriated Chinese renminbi back to Singapore. Not because we were nervous about the market, but it's just a change in our business plan. As you know, we have been transforming under Keppel, and we are now looking more for recurring businesses, recurring income businesses. So we have been repatriating. Now, the recent stimulus that have been announced, I think has provided a much needed boost to confidence. How long that would last, how effective that will change the landscape in terms of confidence remains to be seen. But at Keppel, last year, we did a review of our own playbook for China. I think, as I said, we've been there for 30 years. The China today is very different from 30 years ago. What China now requires compared to 30 years ago is also quite different. So what we did was we figured out what are some of the things that China needs today, but more importantly, what are the areas where Keppel can effectively contribute. And we revised our playbook. So as a result, our focus now on China is more on things like energy transition. Recently, we went into China to provide cooling as a service to some Chinese property players. So as an example, we also think that data centers will continue to be important. So even as there's bifurcation globally, geopolitical risk, I think it's even more important for China to remain connected.
But property remains quite key, and China is a huge part of that. 44%, if I'm not wrong, in terms of your residential portfolio, and 31% for commercial. Give us a sense of, when you see a full recovery, and can the property sector in China get back to the heydays?
Sure. I think for a start, maybe let me correct perception. If you look at our existing land bank in China, I mentioned that we've been de-risking from China. So we sold about $3 billion worth of land bank over the last couple of years. So currently, our land bank as a total exposure for Keppel is only 4%, land bank in China. So our exposure has very much been reduced. I think longer term, we remain confident that I think the Chinese market will continue to perform well. But in the short to medium term, I think the challenges in the property market is quite significant. And we are kind of watching that space closely.
Chin Hua, we just have breaking news right now. We have Apple iPhone exports from India rising a third in the past 6 months. Again, breaking news right here. Apple iPhone exports from India rose a third in the past 6 months. There's always this debate about, whether you should be investing more in India versus China. Your thoughts on the two markets and how they compare?
Well, I think the two markets are going to be very important economies in not just in Asia but in the world. So Keppel has been investing in China for 30 years, so we have some natural advantages there. We've also been investing in India now for 20 years. So we think that there is, quite interesting opportunities in India as well.
Where exactly do you see these opportunities?
We are involved in the renewable energy space. We are also involved in looking at large-scale office buildings. But also at the same time, we believe that data centers is also a very important area. And so this is something that Keppel is very keen.
We keep hearing about data centers. It does seem like an overcrowded space. Do you agree with that?
I don't quite agree. I think it is true that there's a lot of excitement about data centers, especially with the advent of AI. Keppel is certainly seeing quite a lot of demand for data centers from our customers. We are actually quite well positioned because data centers, as you know, is no longer about just providing the data centers. A lot of the customers that we serve, especially the hyperscalers, we are talking to them not just about data centers, we are talking to them about energy, about how we can provide potentially off-grid solutions, low carbon electrons, and also increasingly about connectivity. We are also involved in building, together with Meta, the first subsea cable system linking the US to Singapore directly, bypassing the South China Sea. When it lands in Singapore, it will land on one of our data centers. So increasingly, when we speak to these hyperscalers, I think the conversation is not just on providing data centers, but also providing green energy, providing cooling, and also providing connectivity.
So in 3 to 5 years, how would that business be contributing to your overall strategy and your profitability?
Sure. I suspect it will be quite significant. We have shared recently at our business update for the third quarter that we expect our funds under management for data centers to rise from currently about 9 billion to 19 billion. So this is quite a significant growth. And this is on the back of very strong demand from customers, but equally also strong demand from LPs that are investors in our fund. One of the things that as we transform is that we no longer depend on our balance sheet to grow these businesses. We are increasingly dependent on focusing on FUM to fund our growth. And for data centers, they are getting, the investments into data centers are getting bigger and bigger, especially with the advent of AI. So having that ecosystem is an all-Keppel approach towards solving this issue. So it has to do with data centers, connectivity, energy, and also sustainability.
You've been divesting, but the pace has slowed somewhat. If you take a look at the numbers, I just want to quote you, 279 million Sing dollars till August versus almost $1 billion back in 2023.
Sure.
What are some of the challenges you're facing in divesting?
Sure. I think the market for divesting has been challenging in the recent times. Year to date, I think your number is a bit outdated. Year to
That's
date,
till August.
Yeah. Our year to date up to end September is about 700 million. But we are still very confident that we will hit the 10 to 12 billion. Currently, we're sitting at about 6.5 billion from when we first started in October of 2020. Our goal is to reach 10 to 12 billion by 2026. And we're still very confident that we will get there.
You talk about how it's been challenging. What are the challenges?
The challenges are strictly, I guess, more on the real estate side. I think in markets like China, it's not just about the interest rates, it's about the availability of finance. So frequently you might get a buyer that's interested in buying a land bank that we have or an asset that we have, but they might have some challenges in securing the financing. So hopefully with this stimulus that we are seeing and the goal of reinstilling confidence into the Chinese market by the policymakers in China, I hope that will unlock this situation.
Given the optimism, is there a sense that you might be, planning to have a target of divestment for each year? Is that something you might be looking at?
We kind of look at divestment as something that is a key. We have set certain. I mean, it's very important to us because if you look at the Keppel, the new Keppel is doing very, very well. We're growing our earnings, but a lot of our balance sheet is still represented by the old Keppel. So part of our strategy to improve ROE is to monetize, reduce our debt, and also return capital to shareholders. So monetization is very important to us. So the way that we organize it is that we organize them deals that we can potentially monetize into batches. So every 6 months we have a batch. So it's almost like it's a traffic control. We have flights that are taking off. So in instances where certain assets may be proving a bit difficult to divest, then we will bring something that maybe we had intended to divest a few years later, we'll bring it forward. So I think the goal is to always look for ways that we can monetize and hit the target of 10 to 12 billion.
I want to touch on the area of private credit. You've been trying to fundraise. I mean, where are you with that? And is it also a challenging environment?
Actually, quite a contrary. We're getting a very good traction. We're fortunate because this is not our first rodeo. I mean, this is Fund 3. The team has done very well for Fund 1 and Fund 2. So Fund 3, we expect to raise close to $1 billion US. The first closing should be very soon. We are expecting to have a first close of somewhere between 300 to 400 million US.
But some cite the environment of falling rates as perhaps a hindrance. Yes. Did you expect that to perhaps, be, be challenging for you going forward?
Sure. I don't think so. I think it may be the contrary because when interest rates are higher, investors or potential LPs will say, well, maybe it's easier for me to buy a bond. But I think with interest rates now coming down, I think the fact that we are able to create alphas through this private credit strategy puts us in actually a much better position to raise capital.
Could you just outline your 3 to 5 year strategy now for growth for Keppel? Right.
I think, as I mentioned, we've gone through a very big transformation exercise. We have basically transformed ourselves from what was an old industrial conglomerate now to a global alternative real asset manager and operator. We have made very good progress. And I think in 3 to 5 years, I expect that our earnings will continue to grow. But
and
more
what
importantly,
pace?
I think the pace is, if you look at our funds under our asset management fee, it's grown this 9 months by 68% to almost 300 million Singapore dollars compared to last year 9 months. Now, will we grow at that pace on an ongoing basis? Probably not. I think 68% CAGR is quite strong.
But what's sustainable then?
I would think that double digit is quite easy. I think, well, I shouldn't use the word easy, but it's quite realistic.
But double digit is also 11 to 99.
Yes, I think it will probably be in the 20-30%. I think if you look at our funds under management, our target is to hit 100 billion by 2026. At the beginning of the year, we were at 55 billion. As we sit here now, we are at 85 billion. So I think the 100 billion is well within reach, probably before 2026. But the bigger target is to hit 200 billion by 2030. So of course, it would mean more funds and more fees from asset management, but equally, because of this funds under management, we are also able to grow our other businesses like data centers, real estate, as well as infrastructure. So there will also be other knock-on earnings from those operating divisions as well.
Chin Hua, thank you so much for joining us today.
Thank you.
Loh Chin Hua, CEO of Keppel. Now, in just a few minutes, HSBC will announce third quarter earnings, the first report under new CEO Georges Elhedery. Attention is expected to focus on what the bank says about its latest restructuring. Last week, it unveiled an overhaul that will include merging its commercial and investment banking operations, and analysts will be focused on potential cost savings from those measures. It is also expected to announce a fresh multi-billion-dollar share buyback, and HSBC in positive territory ahead of those earnings, up 0.7%. You can also turn to your Bloomberg for more on this. Go to TLive Go to get your commentary analysis from Bloomberg's expert editors. And still to come, our exclusive interview with GE Aerospace CEO Larry Culp will get his insights on the industry's efforts to resolve persistent supply chain issues. That's next, and this is Bloomberg. Welcome back. GE Aerospace CEO Larry Culp is not seeing an immediate end to supply chain issues that have weighed down the aerospace industry, but he told us exclusively why he doesn't think this will lead to a lost decade for the sector.
It's all about demand, and we look out both in terms of demand for new engines under wing on new airplanes and the support that we provide the airlines for their existing fleets continuing to be strong really for the rest of this decade. It's a good problem to have, and we'll need to increase our output. We'll need to work with our suppliers to increase their outputs to us, I think every year, probably between now and 29 or 30 at a minimum. So it'll be with us for a while, but I think we're making a lot of progress.
The thing is, some had anticipated an end to the problem by 2027, but by the sound of it, it's going to be longer than that. Perhaps we could see a lost decade for the aerospace industry. Would that be a fair assumption?
I don't think we're going to lose a decade by any stretch. Again, I think given how strong demand is and the progress we and others, our suppliers, our airframer customers are making, we'll continue to drive output. Again, because the demand is so strong, we'll talk about the supply chain, but I don't think this will be a lost decade. I think this will be a very important decade as the industry recovers from the pandemic, modernizes fleets, expands fleets with more fuel-efficient aircraft.
But realistically, what can be done?
Well, it really, for us, is all about making sure we're the best possible partner, the best possible collaborator with our suppliers. The vast majority of the input challenges that we have, the shortages that cause us to be late on deliveries, really come from about 15 different suppliers across our supply chain. We have 550 engineers going in to work with those suppliers, identify bottlenecks, identify constraints, and really solving those problems so that we can drive better output from their operations, inputs into ours, and in turn to the airlines and the airframers.
Let's talk specifically about the latest supply chain disruptions and shortage, and that has to do with the castings of high-pressure turbine blades. What's the story there? When can that issue be resolved?
Well, I think there are a host of issues. Again, when you look across the supply chain that we're managing, we've got about 15 different suppliers across a number of different commodities, which are really where we're being paced. So I think in every instance, I really like the progress that I'm seeing. Teams collaborating on the shop floor, identifying the issues that are really the problem. It may be a process yield in some instances. It may be something as simple as staffing perhaps a second shift in others. But by working those problems together, we're driving better output. We had a small handful of suppliers just here in the most recent quarter where we increased our output sequentially by 18%, not year over year, but from the second quarter to the third quarter. It's that type of work, the cumulative effect of that type of work, which will help us.
We know that GE powers the 777X. Its delivery has yet again been delayed, extending that delay to about 5 years now. How confident are you that perhaps those planes will be delivered in 2026? What's the complication there?
Well, I think there's a lot happening there. We'll let Kelly Ortberg and the team at Boeing talk about the schedule for the 777X. I think their last comments talked about an entry into service in 2026. We're thrilled to be the only engine under wing with our new 9X engine. When I talk to customers, they tell me two things. They love that airplane, and they wish they had it yesterday. I think the fact that customers are very keen to see Boeing work through the development and the certification tasks that lie ahead of them is really good news for Boeing. It's good news for us because that's going to be a heck of an airplane once it enters into service.
Airlines like Cathay have expressed a disappointment. I mean, is there a sense, are you confident 2026 is actually viable?
That's the plan that we're working on with Boeing. We know that's the plan that they're working on with every ounce of energy and dedication that they can provide.
You talked about your 9X engine. It's been problematic as well. There are a few challenges there. There have been cracks. Can you talk us through what is happening, what the root cause is, and how are you trying to fix it?
I think you may be referring to a piece of equipment that is attached to the 9X engine, which is a Boeing supplied part, not a GE Aerospace supplied part. So the engine has performed very well over the last several years. It was certified back in 2020. There's plenty of work that we still need to do to be able to ramp side by side with Boeing, but in terms of the core integrity of the engine, we're in very good shape.
So you're saying that it is not on GE to fix the problem, it is on Boeing to fix that problem?
I think the crack that you're referring to is a function of a Boeing supplied component, not a GE engine.
When do you see testing resuming for the 777X? Is there a sense that you're getting in your conversations with Boeing?
That's really for Boeing to speak to publicly in terms of the schedule for that, the resumption of that testing.
I'd like to touch on China. It has big ambitions, Comac, C919. So far we've seen orders of about 300 coming from the big Chinese carriers. What do you make of that number?
Well, it would suggest that the Chinese carriers like that airplane. We'd like to think one reason they like that airplane is because we have our LEAP 1C engine under wing, sole source in that regard. And I think Comac and the Chinese are quite serious about their intentions with that airplane, and that demand that you just cited really is the beginning of the market acceptance of that aircraft.
Do you think it can be a game changer? Do you think it will reshape the landscape in the aerospace business?
Well, I think that we will see over time how successful Comac and the market acceptance of that airplane is, but it would be very foolish, I think, to bet against Comac and their customers.
What are its biggest challenges?
Well, I think any time that you bring a new aircraft to market in a marketplace as complex as ours, again, as we were talking earlier, there is not only the ramping of the supply chain to produce more of those airplanes every year, but the regional and ultimately the global support network that those airplanes will require. That's a serious undertaking. I think Comac understands that clearly and will do everything they can to master that challenge.
That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.